What's up, guys? It's Cash Flow Cart. I hope everyone had a great New Year's Eve. Maybe spent some time with some family or friends. It's actually December 27th for me when I'm recording this, so I'm not 100% sure what I'm doing for the new year. Maybe hang out with some friends or just chill. Not too sure yet. We'll see. But today we have a very special video. We're doing the portfolio update and outlook for January. And I'm going to just go through all my positions and we're going to look at, what estimated annual income each position is providing, what months they pay out. And then depending how long that goes, we'll probably touch on, okay, what's my plan for these positions in the new year? Obviously, that's subject to change depending what the market does, but, we'll be opportunistic. We'll take what the market gives us. So I'm recording this on the 27th of December, like I said. So it shows a little sliver still in December. One more position is going to pay me $7.32, and that is T. Rowe Price. That'll come on December 29th. That's a quarterly payer, so that's roughly $30 a year. I've talked about it before. It's a very small position of just over $650, but it's one I'm really looking forward to building out next year, and hopefully it'll stay around 100, hopefully dip under 100. I'll be very excited. Right now the dividend yield for it is 4.5%, and that's at a $109 share price. So, we'll see what happens. It could change by the time this video comes out. All right. In January, I have two positions paying dividends. This is actually kind of interesting. I think a lot of people, their highest paying months are like the 3, 6, 9, 12. So that'd be December, March, June, September. Oh my gosh, I always forget it does these little like thumbs up things. But that's just a matter of a lot of companies pay on those quarters. And if you have a big position in Altria, just with how high that dividend yield is, you might also see that January, April, July, and October are your highest paid months. So, like I said, two positions paying out. We'll look at the next pay date. That's going to be Altria on January 10th, and the estimated annual income from that one is $968 and change. So, that breaks down to what? That's going to be a $242 paycheck from Altria. And then the remainder of that month's income is going to be coming from Realty Income Corp. We said that'll be a $54 payment. That is my only monthly payer, Realty Income, currently yielding 5.33%. And we'll look at the charts and maybe touch on this, but for me, this is one where my cost basis is not the best. The market value of this position is $12,300, but I definitely have, more capital in it. And the reason why I mention that, and on this channel, I'm going to try to be as transparent as I can about if I'm up or down on a position, where my head's at. Although I'm, theoretically, I don't want to sell these positions at some sort of capital gain. I think as a dividend investor, it is very important to pay attention to like your open profit or your open loss, because it kind of gives you a gauge of, okay, how well are you building out positions? How good are your entries? How are you finding value? Obviously there's stuff out of our control, and sometimes we'll start a position and watch it fall for more and more months after we've built it out. But, Realty Income's one. I could definitely be getting more bang for my buck. The annual income estimation for it is $658 and change. We just said that's just over $50 a month. I know this is kind of like a not an ADHD thing, but sometimes in these type of situations, you see these numbers and you're like, wow, I would like to build this to 1,200 annual income, because then that'll just be $100 paycheck every month. So, I just mentioned that because, sometimes this game is just, it's about building conviction, but it is also fun. It's fun to see certain positions pay you out a good amount of money, positions you have good conviction in. And, I really like this monthly payer. It usually pays out on the 15th. I don't know if it's doing the 12th. Maybe the 15th is a weekend or something. Regardless, January 12th, it'll be paying me, over $50. And then we'll look at February. I've got 3 positions that are going to pay me out. That will be Apple and Starbucks, and then obviously the monthly payer, Realty Income. We'll look at March. That'll be 5 positions. Pfizer, which I've built into a pretty good position, but same kind of camp as Realty Income, in that it's fallen since I've started building out the position. I didn't really get some perfect rounded bottom. Pfizer's been tough. Pfizer, if you're in the same boat as me investing in this one, it's been like just dropping. It's been a falling knife, and sometimes you got to take a few swings at things and then just make sure that you don't build the position too soon to where you don't want to keep building if it falls more. This is all stuff that's going to come with like just time and experience in this game. Where was I? Okay, so Pfizer in March, Microsoft in March, and then Coke also in March. And what else? Oh, T. Rowe Price will also be in March, and Realty Income. So that'll be the 5 paychecks in March. That's always fun. I guess sometimes in the months where you have a lot of different paychecks coming in, it's like there's an element of excitement to it, because, on 5 different trading days in that month, it'll be like, wow, I have new capital hitting my portfolio. I haven't even done anything. I'm literally getting paid while I sleep. And even though I've been doing this game now since I was 16, I'm 22 now. The excitement and, you know, not the joy. I don't want to make this like an emotional tangent, but it is a very exciting game to me. And I will say, getting paychecks in the form of dividends never, ever gets old. I'm sure a lot of you guys are in the same boat as me, where you're fired up to see that money hit your portfolio. It's a pretty great feeling. We will look at the market value of each position, and then the estimated annual income as well. And this is for the next calendar year, basically all of 2024, except this one position that hasn't paid in 2023. So my biggest position right now is Realty Income, $12,347 market value. This one has not been number one. Usually when I look at this, it's been Apple, but I guess Realty Income's back up to 58 when it had fallen to like, what was it, 46 a share. Again, I missed a lot of good dip buys on that one, but and that brings me to a good point with Realty Income. There's going to be a lot of noise around like these long tested, long track record, stocks or REITs or ETFs. Like even earlier this year, I know it was real trendy for people to be like making thumbnails, SCHD, it's over. Like just trying to farm clicks. A lot of Realty Income stuff like yield trap. I don't know. It's going to nothing. Maybe I'm making this out to be something in my head, but you guys forget Realty Income has over 60 years of dividend growth. Their literal nickname is the monthly dividend company. They've had a lot of different management with those same, aligned morals, and people were talking about, oh, they're getting too big now, they have to diversify. Okay, I think they're going to be able to figure it out. I'm holding this position. I want to add to it. We'll do a full video discussing my thoughts on it, but I guess the point of that little tangent was just because there's negative sentiment in the short term around different names, as a dividend investor, guys, you really have to do your own due diligence. You have to ask yourself, look in the mirror. You have to ask yourself, okay, what's my risk tolerance? Um, what what stocks am I willing to hold, and what stocks will I not get shaken out of, because there's negative sentiment. At one time or another, guys, there's going to be negative sentiment around every company. I mean, few companies are immune to overreactions. I mean, maybe something like Coke that everyone trusts, but again, people are going to have their own personal views on things. And if you want to do this game and be a true dividend stock picker like me, you're going to have to form your own conviction. You're going to have to look at the numbers for yourself. And, we're going a little overboard on that, but we'll have a lot of content coming out more in detail. Second position I mentioned is Apple. That market value is 12,162, but it only pays me $60 in estimated annual income right now. And seeing these two with such a similar market value in my portfolio and then such a different estimated annual income, I think that brings up a point of like, there's going to be different not so much styles. I guess we'll say style. There's going to be different like styles of dividend picks where some, it's a very low sort of payout ratio and a very high free cash flow type of business like Apple. And you're kind of betting on they're going to continue to grow their dividend. And in the meantime, I'm going to get the total return from not only that dividend, but also share price appreciation. So, we'll talk about that. Total return, and I've already started to preach it on this channel, that can come from growth in share price as well as, the dividend yield upon entry. Does that make sense? And that's one of the reasons why I love dividend growth investing is there's so many like nuances and there's so many different types of plays you can look into, and you can really craft your portfolio to your own needs, your own risk tolerance. Um, you know, Depending also what age you are, um, you might be more biased towards like current income or having a mix of some growers and some more steady guys. This is an amazing, amazing game, guys. I hope you love this dividend growth investing game as much as I do. Number 3, we got Altria, and that is a $10,000 position right now. I've spoken on it some. I do want to build it out more. This dividend yield is too attractive for me to ignore. A free cash flow beast like Altria, you know, what holds this one down and what drives the dividend yield up, I guess, therefore, is to me, it's fears about, legislation, it's fears about changing consumer trends, but those are risks I'm willing to take with this one because they've proven for many years that they're going to be able to generate free cash flow. Their net income is increasing. The trend is the right direction. So again, I do want to continue adding to this one. My cost basis is like 44 a share right now. I want to get it down to, I don't know what I want to get it down to. Honestly, I'll keep buying under my cost basis. But here's an important point we need to touch on. So we see the estimated annual income here for Altria. For me, it's $968. That's almost $250 a quarter, and that's almost $1,000 annually. That thousand makes up a significant chunk, of my total estimated annual income. So I can look at this and I can say, okay, for my personal risk tolerance, I'm willing to build this position out. I'm willing to take the risk on Altria. I'm willing to hold it in my portfolio, but I also need to be careful that I keep in mind, okay, this concentration risk. And as I build this position out and this estimated annual income, makes up a bigger portion of my total, then I do have the concentration risk of, if something did happen to Altria, that would hit, a big chunk of my estimated annual income. So that's going to be another nuance you'll pick up along the way. Everyone wants to talk about like your market value diversification. Oh, what percentage do I put here? What percentage do I put here? And for me, it's always like, okay, I want to have medium positions and I want to have big positions. And then hopefully the estimated annual income can kind of be smoothed out amongst those positions, you know. So with Altria, it's gotten a little overweight. Let's not beat a dead horse with this one. Moving on, the fourth position in the portfolio is Microsoft. This is another one like Apple where I'm up huge on share price appreciation, but the estimated annual income is not really there yet just because they have so many growth prospects and so many different types of businesses and avenues they can pursue that a significant chunk of their free cash flow has not moved into, okay, let's reward shareholders in the form of a dividend, if that makes sense. So, as Apple and Microsoft become more and more mature companies, I think kind of the yield on cost on these two is going to be, very notable. I've heard people reference it as like a yield on cost type of play. Okay, I get that, but whatever you want to call it, just understand you might have to observe different stocks in different sectors with a different lens. Starbucks next up, that's the number 5. Another one, share price appreciation has been good to me. I have 62 shares, almost $6,000 market value, and it pays me $140 annually. And then our sixth stock is Pfizer. I've talked about I'm down a decent amount on this one, as is anyone who's been buying it, in the previous quarter, really. So, we'll see. We'll see what I do with this one. My initial plan was to build it to like a medium position. I wasn't going to be as comfortable building this into like a huge cornerstone. It was kind of going to be like my opportunity healthcare pick, my value play on healthcare, and we will see how much further I build it. We'll have to stay tuned in the coming year. And then that pays me $260 annually. Next up, these are the two newest, the little guys in the portfolio, which obviously I want to build these to, at least medium-sized positions for me. But right now, we got T Rowe at $652, Coca-Cola at $410 market value, and respectively, they're paying me $30 and $13 annually. I just had a video come out talking about these two tickers individually more in depth, and then also talking about Altria, and then also talking about Hershey. If you guys want to check that out, that should be Monday's video. But again, I'm obviously looking to build these out. T Rowe, I'm especially excited about because of that high starting yield, how they've been able to grow their free cash flow per share, and the sustainability of the dividend has allowed T Rowe to, have some pretty impressive dividend increases in the past. So, we'll continue to look forward to that, picking up shares. I think I already said I want to pick it up under 100. And this video is already kind of getting towards the 20-minute mark. So we are going to have to look at the charts, I guess, in the next video or within the next few videos. But thank you guys for tuning in today. Like I said, I'm very excited to see where this portfolio goes. Right now it's sitting at $53,364, and it's yielding total annual income of $2,191. Um, in terms of goals for 2024, I do. I am wanting to get this my main account, my dividend growth portfolio. I want to get it to that six-figure mark. I know that takes time, and I know there's factors outside of my control, but I'm going to continue to be disciplined. I'm going to continue to be opportunistic and try to put my capital from dividends and new capital in, the best opportunities that I can identify. And I think that six-figure mark in this portfolio should come. Um, I don't know. We'll see if it happens in 2024. I'm super excited, guys. I am not letting up with this portfolio. I'm not letting up with the YouTube game. If you're subscribed, I cannot I can't express how much that means, guys. I've been wanting to start the YouTube for a while now. It's just been, some hoops I've had to jump through with my previous job as a financial advisor. I guess there was some red tape to work through. We'll talk about that another day. But thank you guys for the support. And I hope you guys all have a great year. And I hope your dividend portfolio is, moving the right direction. Thanks, guys. Take care.